Hey guys, welcome back. What we're going to do today is we're going to talk a little bit about the Dow Jones Industrial Average and what's been happening over the last couple of weeks in the market. And there's a lot of questions out there as far as what's going on in the market. Is it safe to get back into the market? Do you think the market is going to continue to drop? Do you think the market is going to continue to go up? Or what's going on? There's a lot of different questions out there. So what we're going to do today is kind of talk through it a little bit. But before we get too deep into it, just want to kind of throw the disclaimer out there that I'm not your investment advisor, and that these videos that we make are for education and entertainment purposes only. And if you're looking for financial advice, you definitely need to contact a competent advisor in your area. Okay, so since we got that out of the way, let's get right into this. If you look at the charts here, and this is a very interesting chart. If you look at the charts here, the markets are taking a downturn back in November, October 2007, right? And it slid all the way down up until about March of 2009 before it hit a bottom and then started to turn back up. If you notice, there's a lot of volume in the market. Back in 2007 when the market was going up, and even in 2008 as the market was going down. Now, one of the reasons why we knew this was a really really scary situation, because you saw a lot of volume with that sell-off. So there was a lot of people just pulling money out of the market, a lot of folks that lost money in the market, and they pulled it out, right? When the market started coming back around, I think one of the reasons why a lot of people were kind of skeptical of this recovery is because you didn't see that same amount of participation in the market that you had before the market sell-off, right? So if you look over here and you look at the volume, let's try to go back a little bit here. And look at the volume. I mean, there was a lot of volume, significant volume in the market from about 2000 all the way up into 2008 when the market started to drop, right? But if you look for the recovery, right, it was just never there, right? It was like below average volume. So how did the market continue to go up even though it wasn't the normal amount of market participants in the market that you would associate with a recovery? Well, one of the reasons why is just because of when the Feds went in and they lowered the interest rates and just made it incredibly cheap for companies to borrow to expand. By them doing so, allow for companies to go in and replace old equipment, to modernize their facilities, and then to begin to hire folks to come in and to work in these facilities. Now, the way that the whole lowering the interest rates works is not only does it allow for companies to bring in new equipment and modernize because they can borrow at a cheaper cost, but when they start to hire and bring in new employees into the company, these new employees with these new salaries, they then go out and they're able to spend their money in the market and purchase goods and services for themselves, whether it's a new automobile, whether it's a new home, whether it's clothes, whether it's food or whatever, entertainment or whatever, right? And as they spend more money in the market, or in the economy rather, more businesses are able to make more money because more money is being passed along to them, right? Because if they're purchasing automobiles, then not only the auto industry is making more money, but the folks that make tires, the folks that make seat belts, folks that do the paint jobs, folks that do whatever, they're making money. The parts, whatever, they're making money because more money is being spent on automobiles. And as they're making more money, these different companies that that contribute to the production of the automobile or whatever goods and services is out there, if they're able to make more money, they're able then to go out and hire more people, right? There's going to be a need for them to hire more people because, hey, we get more demand for our goods and services, so we need to hire more folks to come in and help with this. And so as they hire more folks, those folks now have higher wages and they're able to go out and spend money on goods and services themselves, and the economy just kind of spirals up from there. And that's really what we saw happening, during the recovery from the Great Recession, right? Is that you had to have that cheap money out there so companies could get back on their feet because they had lost a lot of money and the people had lost a lot of faith in the economy just because it was a mess. Now, as we go into 2015, 2016, the economy actually, well, I won't say the economy, but the stock market starts to consolidate and starts to kind of move sideways. Rightfully so. It had a huge upward move all the way from 2009. Right, went from about 7,000 all the way up to about 18,000. So it was a huge move in a short period of time. So it started to consolidate. And if you look closely, not only did it consolidate, it actually made a double bottom, right? Here's a low, there's a high, right? Let's see here. And from this double bottom, it actually had a breakout. And from this double bottom, you actually had a breakout, right? So if you look right here, price came up in 2015, tested a high, right? And then it went back down, tested a low. And how do we know we got a high? How do we know we got a low? Well, we know we got a low because what? 2 candlesticks on the right were higher than it. 2 candlesticks on the left were higher than it, right? That's a low. We got a high here in the middle. How do you know you got a high? 2 candlesticks to the left were lower. 2 candlesticks to the right were lower. And then you got a low right here. Why is that? Because 2 candlesticks to the right was higher. 2 candlesticks to the right was higher, right? So low, low, high, right? Double bottom. Price went up, tested that resistance zone, and remember we kind of talked about this in some earlier videos about support and resistance zones. It tested the zone here, came back down, came back up, broke through the zone, right? Then it came back and it tested it again. And so what happens is, and I think we spoke about this before in another video, resistance, which was here, here, and here, now all of a sudden becomes support here, right? And what happens from here? It takes off, and it really takes off, right? And I don't think there's any I don't think there's any coincidence that this happened right around the time that the elections for 2016, so this happened in November, right when the Trump administration won the elections. And I think it was the reason why is because there's a lot of expectations as far as job growth, infrastructure spending, tax reforms. I think a lot of that played into as far as the market taking out the way that it did. And as you can see right here, not only was I thinking that, I think a lot of other people were thinking it as well. And that's why you see the volume that you have right now that came into the market starting with the Trump administration winning the election in 2016, right? So now that kind of brings us to where we're at today, because recently we had some pretty big downtrends in the market, and it makes people kind of wonder, like, well, what's going on? is the ride over with? What can you know what are what's gonna happen next? Well, I know everyone has their opinion, so I'm just gonna offer my opinion today as far as what I see, and what I think the market is gonna do. I do think that overall the market, the fundamentals are great. I think the market is healthy overall. I think the fundamentals are there. But what I do believe is that uh, inflation is starting to creep in. And when I see this type of move right here, that lets me know that somebody else sees it too, right? And I'm not talking about the mom and pop investors or the blue collar worker who's been at the job for 30 years and they're getting ready to retire, in a couple of months or whatever, because they're not looking at their 401ks. They're not really mom and pops, the blue collar workers. They're not paying attention to what's going on in any investment accounts because their 401ks, they set it and forget it. They've started putting money in there 15, 20 years ago, and they haven't even changed the allocation since. When I start seeing moves like this right here, that lets me know that's somebody with money and knowledge that's saying, hey, you know what? We need to get out now, right? That's either, it could be a foreign government, it could just be bankers on Wall Street, but that's somebody with some really good knowledge of how the economy works and some really good foresight of what they see the future holding. And they're getting out and they're saying, you know what, we're out of here. And it's kind of a coincidence too, if you think about it, that this would happen about a week after the richest people in the world met over in Switzerland, right? Then all of a sudden the U.S. economy takes like a 1,100 point dive like on that Friday. But I'm not going to get into that. I'll let my conspiracy theorist friends step on that one. I'm not going to go there. I'm just going to keep with the with what I see right here, which is this chart, right? When I look at this right here, I said, wow, that was a big move, and that had to happen for a reason. Now, don't get me wrong. I think that part of it is just because you had an overheated market and they need to pull back, right? You need to catch his breath a little bit. But I also think maybe someone is seeing the effects of inflation, and what they're doing is they're trying to position themselves now to go ahead and get out before the Fed starts raising the interest rates. And the reason why that's so important is because once the Fed starts raising the interest rates, that essentially makes the cost of money more expensive. And when it makes the cost of money more expensive, then that means that corporations are more or less rather likely to borrow money for expansion. Well, if they're not borrowing any money for expansion, they're not modernizing their facilities, then what's going to happen? Well, people are going to stop being hired, right? And if people are going to stop being hired, well, people are going to probably stop spending money. And if people stop spending money, then that means that corporations are not going to be making the same amount of money they were making prior. So that means at some point in time, they're going to have to start laying people off, right? And if they lay people off, well, those people are not spending money. And some of the stuff that they started buying when we was having this expansion, like the cars, the homes, the boats, all that stuff, well, guess what? Those payments still have to be made, but if those people are not working and all of a sudden they can't make those payments, so those things start to go back. So not only those things go back, but no new things are going to be purchased. So no new homes, no new cars, no new large ticket items. As that starts to happen, the economy starts to contract. And as the economy starts to contract, that means earnings go down because companies not earning what they were earning prior. And as earnings goes down, that means investors are going to be looking for someplace new to put their cash because they want to keep making returns on their investments, right? And I know that's kind of a lot that I just kind of put in there, but I'm saying all that to say this, that this right here, I think may be the warning shot of what is to come. I don't think there's no coincidence either. If you look at this trajectory, I mean, of how this market is going up, I mean, that's a pretty steep incline right there as far as how it's going up, right? And then the fact that it came down, touched this trend line, and then of course it bounced back up. Now, don't get me wrong, this thing could continue to go up for months and months and months, maybe even years. I don't know. Like I said, I think right now, honestly, I think that the underlying fundamentals of the economy are actually good. But do I think it's this good to be at 24, almost 25? No, I don't. I think that a more realistic or a more realistic spot for the economy right now, for the market right now, would be around the 22 area, right? 22. I think that's probably more or less where it should be at. 22, 21, right? Say somewhere around in here. It's going to be interesting to see how this is going to play out over the next couple of weeks. I do think if you see a break of this trend line here, so if you see a break below, let's see, 23.5, then kind of look for it to come back to around 22. And once again, when these things break, it's not going to be a perfect break, so it will probably pass through it, come back up, pass back through it, right? Come back up. But I think around here, around the 22, 21 mark is where we're going to wind up resting at. And I think then we'll probably consolidate for a while. That's my own personal opinion. And the way I get that opinion from, once again, is just looking at the trajectory of this market, and then looking at the fact that the way the trend line is positioned on here, just looking at from strictly technical analysis standpoint, but then also kind of factor in a little bit about the fundamentals as far as what I know to be potentially the direction of the Feds, because they already said that they're going to increase the interest rates. And so if they plan to increase the interest rates, then you can plan on looking at the market slowing down at some point. And always kind of keep in mind and remember that when we look at the stock market, it's a forward-looking animal, right? So when you look at the price today, where things are priced today, that's not what the investors are looking at, saying that this is what they're worth today. This is what they're looking at and they're saying this is what we think that they're going to be worth at least 3 months from now, right? This company we think is going to be is valued at this at least 3 months down, 3 to 6 months down the road from now, right? They're basing everything off of expectations, and I think right now the expectation is that Feds are going to start raising interest rates, and when they start raising interest rates, the economy is going to start contracting. When the economy starts contracting, businesses are not going to make the same money that they've been making. The earnings are not going to be as spectacular as they have been. And what's going to happen is investors are going to start pulling out of these corporations and maybe start going into bonds or someplace where they feel like they can get a better return for their money until the economy comes back around. Okay? But anyway, that's my thoughts for today. And if you guys got any questions or comments, please feel free to let me know. Look forward to talking to you next time. Take care.